So one of the hardest things to overcome in the market is our own selves. Because we were never taught, and not we in a cultural or a race way, but we that are not in the 1% were never taught financial freedom and ways to create generational wealth or anything outside of the Harry Truman show, which is just waking up, going to work, coming home, sleep, and do the same thing. That isn't anything that we were encouraged either. So when you have this sense of, I believe the quote, and I'm probably saying it wrong, but it's not it'll come to me, but it's our greatest fear is how powerful we are. And I just paraphrase that, right? When you have total freedom sitting right in front of you, and you've never been encouraged ever to grab that total sense of independence and freedom, it's an uncomfortable sense of change that you have to grow through. Not go through, but grow through. And in the market, there's not much to learn. We choose to continue to learn because this should be a career that is a moment of or something that is continuous education, right? It's always something to learn. It's always a new strategy. But at the end of the day, a bullish engulfing is a bullish engulfing. This green candle is saying this support level or this key level will always be there, right? There's not that much to learn when it comes to understanding trend lines. Once you got it, you got it. There's not that much to learn. Well, there's a lot to memorize, but not much to learn when it comes to reading a candlestick. Once you got it, you got it. There is a lot. There is a lot to learn and how to get over yourself so that you can grow and elevate above yourself. So today, what I really wanted to talk about and in this session is how we overcome any barrier that is in front of us and how the way that we overcome barriers in our real life will very much so directly translate over into the barriers that you will face on the market. And again, 90% of it, we've all heard that phrase, that saying, right? Trading is 90% psychology, meaning that 90% of the barrier that you have to overcome is yourself. So today we're going to we are not figure that out, but today we're going to go through that and learn how we can overcome the market, outpace it. I wanted to start off with, this is a scripture that I have sticky taped on the little Post-it notes, whatever you call them, everywhere. It carries me through a lot. This is a scripture of resiliency that you literally have to. It was, I'm not gonna say it's a commandment, it's not a commandment, but this is a clear instruction that we were left. You have to armor yourself, especially over here in this market. So of course I'm gonna start off, and at the end of the day, the first thing, the last thing, and everything in between that we need to understand is that there are only 4 phases in the market. To go look for anything else is doing yourself a disservice. If you understand these 4 phases, congratulate yourself. Don't go look for something else. This is simply it. The economy is run on supply and demand. It always has been. I could go deep with it and say, if we go to the first chapter of Genesis, that was an example of supply and demand. In order for him to give us light, there had to be darkness. If we look at the exchange between Adam and Eve, that was a supply and demand exchange. I'm going to give you this because I want this. Conversations are supply and demand. I'm supplying what you want to hear because you're demanding to hear what I have to say. And as soon as I'm done talking, it automatically switches. Now I'm demanding to hear your reply, and you're supplying that reply to everything. Goes back to supply and demand. We see demand in the accumulation phase because prices are at lows. I think that there's three things that I want everyone listening to this to write down and say it as an affirmation for you every day. Number one, the market is a long-term marathon, the end of the road game. Get quick rich schemes never work out consistently and long term. The market is a long-term game. In order to succeed in anything financial, you have to get the best deal. Which leads us to the second thing you need to remember. Your only goal in the market is to buy something when it's at a low so that you can sell it when it's at a high. And I'm going to get to the third thing later on, a few slides down. It's important to remember we're coming back to it, but I need y'all to write those things down so that it's not something that's just going in one ear and out the other. You need to understand, oh no, that's it. That's it. We got 4 phases. Oh, well, I gave it up there. We got 4 phases. That's it. That's all. The market is a long-term game, and I need to buy low so that I can sell it when it's high. So after we are, and we only are going to use the words literal, right? We're not demanding to buy something at its highest price. We're demanding to buy it when it's at a low. That's the accumulation phase. We understand that buyers create demand and push the price up. Eventually, things have to stop. Why? Because eventually we need to get paid. Eventually, we're buying things higher than what they're worth. It's natural. It's just evolution. When he gave us sun, he gave us the moon as well, right? If it goes up, it has to come down. It's gravity. There's nothing more in between the lines except there are 4 phases. What goes up has to come down. So, right. The first thing that I want to get into with you all today, well, other than going over those phases there, is that get it done out. Rebalancing our portfolios. I couldn't get the word out. I'm looking right at it. So some things that we're going to go through with this when it comes to adjusting your portfolio, which we got to, right? Because the economy is not always up and the economy isn't always down. So we have to adjust our money with where the economy is at. So it is so important to remember fact number 2, end all be all number 2, whatever the word is that I should use. Buy low so you can sell high. When that market pulls back, you have to train yourself to not panic, because what is there to panic about? You have over 100 years of data sitting right in front of you that have shown you that the market always goes back up. And when it goes back up, it goes back even higher. So choosing to panic, because that's what we're doing, because we have facts, cold, hard facts right in front of us. Choosing to panic does nothing. When the market pulls back, you get excited. You have to train your emotions to understand that that is an opportunity. A red candle in the market is nothing but an opportunity for you to create wealth. So it is so important to have cash reserves when that's happening. When you see that the market is going to drop. Now, how do we know when the market is going to drop? Because we understand there's only 4 phases. So if we've been uptrending and all of a sudden the market stops and it starts to consolidate, guess what, baby? It's only going to do one thing: drop. That's it. There's nothing in between that. That is it. After the market has uptrended and it starts to consolidate again, it is time for you to be ready, to be excited, and to have cash. Why? Because rule number 2, buy low so you can sell it high. The strategy is found, or the strategy, I I put here like strategize for minimal risk, but I really want to say like during consolidation, that's when you game plan. That's when you game plan. You're prepared for it. And if we're looking on a higher time frame, we don't have to guess, oh, when it gets to this distribution phase, when it gets to this supply zone, when it gets to this high, to this resistance level, what's it gonna do? Drop. We don't have to guess. There's only 4 phases. We get that. All right. So the strategy is done. The strategizing, the game plan is done during the consolidation. You should already be prepared when the market breaks to the upside and uptrends, or it breaks below and it downtrends. You should already be prepared. Why? Because you know. You know. So let's get into it. How do we rebalance our portfolio, right? It's, of course, we know it, but all right, let's dive into it. How do we rebalance it? You need to understand what assets are underperforming. What's underperforming or overperforming? We need to reduce our exposure to higher risk stocks, which are typically tech stocks, financial stocks, energy. We definitely know energy is a high risk stock. Anything over there. And we need to increase on things that are going to pay us. Bonds, dividends, inverse ETFs. If you have a problem, I don't want to even call it a problem. If you aren't in that headspace, you don't have the capability, and you don't even want to find the ability to trade puts, don't. One, you can either sit on cash. Why? Because then you'll have those cash reserves for the bounce. Okay. Two, you'll still be getting paid. So psychologically, that's going to help you. Did I even say one the first time? Psychologically, it'll make you feel better. And 3, it's, wait, I went back to dividends. I'm sorry. So the ETFs, yeah, just trade it opposite. Move, Sky. Move. All right. And like I said, we need to remember that we're not panic selling. That's not what we're doing. You're taking profit. You took profit at highs. And honestly, the smartest, lowest risk thing to do is take profit and wait on the market to bounce. Like, I've never seen a downtrend that wasn't full of fear. Never seen a drop in the market that wasn't full of fear. I don't want to be involved in it. So I'm going to strategize and prepare myself during the consolidation. So again, when we're rebalancing during a pullback, it's just about adjusting our investments in our portfolio so that we can protect capital, so that we have capital to be able to buy the bounce. So starting by assessing what is underperforming and what's overperforming, and we're going to get into that, is the main thing that you need to do. And the cash reserves is just a financial cushion. You want that. So what does an underperforming stock look like? What does it look like? Listen, you have to compare. You're gonna have to do a little bit of work. You're gonna have to do a little work. There's no resource that I know about that you can get on and just type it in and it's just gonna pull it up and tell you. The path to financial freedom involves a lot of sacrifice. Find the time. So what you're gonna, in this, well, hold on. So you want to compare that, and I'll just say that we're doing Apple. You're going to want to compare Apple to its major index first. So we know that Apple, the major index that it's in is NASDAQ. So we want to compare its performance against the NASDAQs, because if it was outpacing the entire index, that's overvalued. It's overperforming. You're a little bit too above your value. I'm not going to buy it. If you're marked up 70% above your actual value, that lets me know I need to wait. I missed that opportunity. That's okay, because the market will grant me another. You definitely want to then focus on down to comparing it to stocks that's in that same industry. Now with Apple, that probably wasn't the best example, because when we looking at the S&P, it's the only thing in that industry. So we'll go with Exxon. So our within that industry, we would compare it against Chevron. All right, as well as that in that sector too. But mostly really just the industry. I'll say it like that. Then you're going to want to compare Exxon against its historical average. So here I wrote, if the stock usually gains around 8% annually, but has only gained 2%, or it's even lost value in the current year, it's underperforming. Now, a stock that's underperforming, if it is a good company, is the best time to buy it. If it is a good company and it is underperforming, meaning it's undervalued, I'm really going to switch to saying undervalued, that's a good time to buy. If it is a sinking ship company that is undervalued, it's a sinking ship. Leave it alone. We only want to buy low on great companies. And I could go with Nike for an example. That's at the top of my head. Nike is a sinking ship. You have to actually go in and look at the financials in order to understand, well, should I buy this at a low right now? Or is this company losing revenue quarter over quarter and year over year for the last 3 years? Maybe it's a sinking ship at this moment. Now, you also want to review analyst ratings, price targets, revisions that were done by the analyst, meaning was it upgraded or downgraded? That will definitely let us know if it was downgraded like 4 or 5 times in a row and it's already underperforming the rest of its industry sector and index. Maybe we might not want that. Also looking at the company, so Exxon, for example's dividend yield, and again, compare it to its competitors. If the company has to cut dividends or the dividend yield is lower, it's a signal that it's underperforming or undervalued, right? And again, we need to actually dive in further to look at that company and with its financials to understand whether or not this is the value company that we're getting at a deal or a sinking ship that we just want to leave be. So what I wanted to say at the top of this screen or at the top of this slide was going through all of this is exactly why we are told, advised, strongly told and advised, you don't need to invest in too many individual companies. So what does an overperforming stock look like? Okay, meaning if Exxon's true value is $100, but it's currently trading at $150, why would I buy that? You're overvalued. I need to wait for the market to drop because it's going to come around every 3 years. And we're remembering rule number 1, the market is a long-term marathon game. Baby, you might gotta wait. So I let the math make sense on that one. And then there is, again, we're comparing it against the major indices in the market. So if Exxon, like I wrote here, if Exxon is up 30%, but the S&P is up 10%, you're a little pumped. You're a little pumped. Might need to wait on you to come on down. And then the same example here for tech, if you're doing it against the competitors directly in its industry. All right, so when the market is overvalued, let's get into it. So there is a financial metric, the PE ratio. So it stands for price to earnings ratio, meaning that we're going to take the current share price and we'll say it's Exxon, right? And the current share price is 100. And then the earnings, which is going to be the revenue for the last 12 months. So the trailing 12 months revenue. So if the current share price is 100 and in the last 12 months, 52 weeks, they've made $1 million, we would take 100 divided by 1 million and get a number like 1 point something. All right. Now that number then translates over into the EPS, which is earnings per share, most often heard about during the earnings reports. We can dive into that Further down the road, if there's anyone that I haven't done a financial metrics class with and you really want to get into it more, would love to. But so this PE ratio, all financial metrics at the end of the day, every single one of them, I can sum it up for you. Every single one. I don't care if it's the PE ratio, PB, which is the price to book, PS, price to sell. I don't care. Every single one of them is telling you, is this stock overvalued or undervalued? All of them. So the price to earnings ratio for SPY is typically in the range of 20 to 25. Anything over that is considered overvalued, right? Currently, SPY is at 27.45. That's not too overvalued, but that's enough to let me know that we're not going to run up too much longer. Before the bear market, like right when it's about to drop, we typically see SPY's PE ratio get to about 30 to 33. It's coming. So we need to monitor key economic indicators. So I will have this PowerPoint turned into a PDF file. And on each one of these, almost every one of these slides, there's going to be a link that you will be able to click that will pull up definitions for you, a link to Investopedia, a YouTube video, et cetera, that you'll be able to click on. And I highly suggest that you all take the time to go over the 7 major economic indicators. I have pointed them all out to you on Econo Day, because that's one of my non-negotiables that I give myself as a mentor to make sure that I do show you that feature on Econo Day. So one of the top 7 economic indicators is going to be GDP, which is the gross domestic product, which comes out once a month. And you can look at that thing and it will tell you how much consumers spent on bread in the last month in the US, right? So we're able to really see where consumers are spending more and less money at month over month. We also are going to want to look at unemployment rates, consumer spending, right? Which is going to go into the CPI, PPI, et cetera. We need to know those things. Because when the data is just coming in to just sum it up back to back to back, bad, it's not going to go away. It won't go away, right? And funnily enough, the way that it goes away, or I'll say, and what happens in order for them to fix it is the market usually needs to drop, go into a bear market. Typically come out that market and spending is a little bit better, we see. And then we also want to watch investor sentiment. So one of the things that we can look at is the fear and greed index. We definitely want to keep up with that. You can simply just Google it and it will pop up. All you gotta do is type in fear and greed index, it'll pop up. There's also a link in the tools tab inside of the Discord. Now, something else we want to look at is, we have talked about this, is with IPOs, seeing an excess amount of IPOs coming on the market real fast, quick, in a hurry. Also things such as stock splits, seeing a lot of meme stocks gaining power again. These are all signs of the revelations. All right, so how much cash would we want to have in reserve? I've always been taught and teach 10 to 20% of your portfolio in cash is the goal. That should be your goal. If you're willing, if you have $1,000 sitting in your trading account and you're willing to risk $1,000 trading, you should be more than willing to invest 20% of it into a stock that is on sale. And that's all I got to say on that one. And how can we minimize risk? How do we do it? Diversify. This just takes us back to diversifying. Having your entire portfolio in one sector, it's just not good. Also using stop loss orders. That's fine as well. Why not? You can set stop loss orders on your investments in your portfolio as well. Depending on how you do it, I could walk you through how to do it on Fidelity and other than because that's the brokerage I use. Other than that, we can look it up and find some good YouTube videos together. But I do know that as far as I'm aware, all brokerages allow you to set stop loss orders, whether you're trading or investing. Good. To trust me, they want you to keep your money in there too, right? All right, so now let's get into knowing when to buy. What are the signs that it's time to buy? When all the headlines are doing is telling you that the market had its worst day since blah, 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 it's time to buy. When we see that the market is consolidating at highs, it's time to go cash. And when we see it drop and find a level of support, it's time to buy. I've noticed that every pullback this is when I have psychology classes more than technical analysis classes, which I love. And I understand that's my job as the mentor is to understand that this is new and that until you put your money into a dip and see the returns as it goes back up, that it is a fear that you have. But again, fear is a chosen emotion when you have facts in front of you. So choose to rely on historical facts and data. Right? So one of my favorite things, or I'll just say something that I like to note, and perhaps some of y'all have heard me say, is that when I start to get antsy, I go right onto that weekly time frame and I'm like, oh, we're consolidating at highs. Got it. It's a designed emotion. It's a designed emotion. You're gonna feel the, and then you start to grieve all those green days, all those green candles, right? Because we aren't trained to see money in the color red, right? And think that that's an opportunity to make money. So now you have to train yourself for that. We definitely want to wait on confirmation. So coming out of a pullback, I will be one of the last to enter. So for example, I could see a morning star pattern on the support trend line that closed above the 9, 20, 50, 100, and 200 because it was all sitting there just consolidating. And it closed real strong above them all. RSI did a bullish crossover. MACD did a bullish crossover. High volume. And I'm still not going to get in on that third candle. I'm still not going to get in. Why? Because a morning star is a 3 candlestick pattern. The only way it can be confirmed is if that 4th candle goes higher. So I might see that bounce, but I'm gonna mind my business until it's confirmed, even if it's on the weekly, even if it's on the monthly. And that helps. I have no doubts if I show up late to the party. You ain't gonna say only, but you're at your most anxious and at your most nervous and at your most point of lack of accountability when you don't have a plan. So some buy signals that we have is oversold conditions. When we see prices at a strong support level with, you know what I'm saying, with some bullish price action, things like that. The 4-for-4 setup. That's what we want to see. Higher lows being formed. So an oversold condition is when we see MACD make a bullish crossover when it's in negative territory, or when we see RSI below 30. And so on a side note, I know that I've gotten requests. A lot of times I intertwine when y'all talk about indicators, I intertwine it into the swing trade watch list. So I did get some request about that. So I would say check the watch list because I explain different uses of moving averages, RSI and MACD. So how can we pick what the heck? Yeah. So how can we pick the right contracts? How can we pick the right contract? Whew, we got to look at everything that's written on that contract, all the aspects of it. Okay. We need to make sure that we're choosing the best expiration date, strike price that has the best IV on it, that has liquidity, meaning that there's enough volume on that specific contract for me to enter. And again, the only way that something can be the best is if you can afford it. Meaning, and what I mean by afford it is if you have $2,000 in your trading account, you should only be risking 10%. In my opinion, let's be real, right? You should only be risking $100. So if you put $400 into that trade, I need you to understand that you can't afford it. You actually cannot afford to put $400 into a trade if you have $1,000 account. So, can you afford it? And do you have a game plan on when you're going to sell it and why? Other than that, there's what's good for the goose might not be good for the gander because people have different psychologies, different capital, different time, different goals. So as long as you sat and you looked at all of these aspects and you know why you chose them. So if someone comes to you and says, why did you choose this strike price? And you say, because this is $3 away from my target. Because I pulled up the options profit calculator website and I went and I saw on there, as long as this makes this move by this time, I'm going to be in profit by this much. If somebody comes to you and they ask you, why did you choose this expiration date? Because this is the amount of capital that I had to hold it for this long, because I know according to the indicator ATR, Apple moves $10 a week. So I bought this contract with this expiration date expecting to be able to hold it. Why? Why? Right? As long as you know why, the answer is good. And I pretty much said all that. So the best thing to do is to buy slightly in the money or right at the money. That is going to be the most expensive thing to do. Right? Anything that is going to make it a little easy on us to make profit is going to be expensive, to sum that up. So to buy in the money or right at the money, it's going to be a little expensive. For those who have not talked to options about, you have a year. We will get there. I don't think that that's always feasible. When I was growing my account, it wasn't feasible for me because I was also paying my bills while I was growing my account, right? It wasn't feasible. So I started buying out of the money and buying my target. I just started planning it to my target. I'm going to hold this trade to my target. It became habitual for me because it was what I could afford, was to buy further out of the money. So then it became to the point of, well, girl, you gotta hold this. You have to hold this because this is what you can afford. So okay. With a strong setup, buying out of the money, that's fine. That has a great risk to reward as well. You need to make sure that you buy enough time. Realistically, ideally, 1 to 3 months is what you want to go into. So again, I say to look back at ATR. So if Apple's average true range a month is that it moves $27, I'm going to look and I'm going to say, okay, you're going to move $27. If you break over 100, I'm already expecting that you're going to get to 140. Okay, cool. So let me start looking at the 130, 135, 140 strike price where I intend to hold this trade to based off the technicals and all the research that I did before I got into that trade. Now, if I see that, I'm like, okay, well, this is going to overshoot it a little bit. I'm going to go 2 months. Now, buying out of the money, because it is going to be more affordable, right? Because at this point, we're buying $30 out of the money, but we're going to buy time. It's going to be more affordable. Now you need to buy multiple contracts because guess what you're going to do? what you should do. In my opinion, I can't say should. In my opinion, based off my experience, what you're gonna do is now every few days, you just wake up and sell one of your in profit swing trade contracts to pay yourself so that psychologically you don't feel the need to go sit down and go to the casino, right to the slot machines. Buy enough, right? Do the math. Take time, sit down, plan it out. For every trade, as you're growing your muscle, your stock market muscle, every trade that you plan out, honestly, it should take you, in my opinion, a good 30 to 40 minutes because you need to chart it. You need to backtest your chart. You need to go find the contract. You need to go and pull up your resources and make sure that the buying is being done. If you're looking to buy it or to, buy calls, you need to make sure that, hey, is the market also of that opinion? Because if they ain't, you might need to refigure some stuff. Go back to step one. It should honestly take you a good 30 to 45 minutes. Because then you need to sit down and figure out 3 levels to the upside, 3 levels to the downside, so that you're not sitting with your, so that you're not left surprised. At no point should you be left surprised. Why? Because you should prepare. You should be prepared. Anything that's ever given you a panic attack while you are actively trading, to not prepare for it in your next trade is doing yourself a disservice. Now, your risk to reward needs to be on point. All right. 1 to 2 ratio is litty. I go for a 1 to 4. Yes, I said it. I look for a 1 to 4 setup because it is the 4 for 4 and it gives me higher confluence. So if you're doing 1 to 2, you're going to risk $1 to potentially make $2. All right. So large gain, small loss. Implied volatility. Let's get to it. Let's get to it. Let's get to it. So I'm going to go through it, aware that maybe for some who's listening, it's going to be a little bit of a head spin. But remember, all you got to do is click rewind. Take some time to sit with it. And don't move on to a new subject until you feel comfortable with this subject. If it gives you a head spin, now you know what you should take time to study for a week or two. So IV stands for implied volatility. We know that the word volatile means that something is subject to a quick and sudden change. It doesn't mean it's violent, it just means that it's sudden to a quick and a sudden change. And when something quickly and suddenly moves in the market, when does that happen? We know it's going to be a lot of volume when it's breaking out of a range, out of consolidation, out of the accumulation or the distribution phase, or phase, right? Is running. We should have us a good price move going on. So IV is very, very important to pay attention to. So a high IV, and this has to do with options contracts, as well as so high options contract. So high IV is going to make the premium, the cost of that contract more expensive, of course, but we have a game plan for that, right? But it's also telling you that there's a bigger move in price coming. A low IV is definitely letting you know that there is not that big of a move that's coming as far as the price. So we have to pay attention to historical IV. This is another reason why it is heavily suggested and advised to us that, again, the things that you trade, you don't need to trade. You don't need to have too many things on your watch list because you need to know something like this. Because guess what? When you pull up your option chain, it doesn't tell you what the historical volatility was. It'll tell you what the IV of that contract was, but it will not tell you what the historical IV was. On my main watch list, like what I personally trade, I could tell you what the historical volatility is for every ticker on my watch list. And you should be able to tell someone what the HV is for your watch list as well. You have to know its personality. So if the current IV is higher than historically, that's letting us know that the market is expecting a big move coming up. So I look for something like that. If I see a setup on my chart and I'm like, man. So for example, when you watch the watch list, I see what is a bull flag breakout on XLC coming. I see it coming. I went and I looked at the volatility, the IV for XLC, and it's 7% higher than what the historical volatility is, which just gave me confidence that, oh, my eyes are on the, got it. My eyes are on the communication services sector this week. Got it. If the current IV is lower than average, it's just the opposite, right? So now let's get into the IV percentile, also known as IV rank. You'll see it both ways, just depending on what resource it is. It's all the same. So this is showing us where the current implied volatility is in relation to its past values over a year. Not historically over all time, but over the last year. So a high IV percentile or high V rank, which is going to be anything above 70, is showing us that the current IV is higher than IV in 70% of the past data. That's too much. You too high, you got a big move coming. Wow. We like high IV. I want to see the current implied volatility higher than the average in the current IV rank higher than average or above 70. And then a low IV rank, just the opposite. Now let's also look at implied volatility across different expiration dates. Okay. The closer the expiration date is, the IV, if the close expiration date IV, what did I write here? Is higher than the further out expiration IV, then the market, again, is expecting a bigger move or higher volatility in the near future. And if the IV is pretty stable, it's just like trading on average, or it's lower on all expiration dates, it's just showing us that there's just mind your business. That's when you're typically going to see that the spread, meaning the difference between the bid and the ask of the contract, is going to be higher than it's going to be wide, because there's just no agreement, there's no interest in this at all. You definitely need to make sure though that you take into account earnings, especially if you're buying let's say that you are buying a 3-month expiration date. More than likely, highly probable, you're going to be holding that trade into earnings, which you should account for that in your plan, because maybe you want to cut that trade and take profit before earnings, or maybe you want to be prepared for what will happen if you do hold it through earnings. Compare. At the end of the day, you got to put that work in and compare. So you need to compare the IV of this stock across the IV of its competitors and the market. So I have some examples here on the screen for you that I think these will just be good, covering everything that we just went over here. That's a crash course on implied volatility. But if IV or Apple is at 50% versus its historical volatility of 20%, that's considered high. We should expect a move to come, a big move to come. If the IV percentile is 85%, that's high IV. We're expecting a big move to come. If the IV is lower than its competitors, we're not really expecting that much of a move. Now look how you can translate this. If the IV across the options is at 85%, the IV percentile is at 85%, which lets us know that some volatility, some implied volatility is expected to come. Now, what if you see that the IV is 85% and the market is consolidating at highs? Isn't that just a source of confirmation for you of, oh, a big move is coming? Because what happens after the market consolidates at highs? It drops. So what's the best thing that we can do so that we could get a broad view of the market? Pay attention to the IV of SPY. Now we want to get into the mental game of the market. You gotta stay strong. You have to stay strong. Letting anything knock you off your game is just At that point, you have to realize that you're holding yourself back. The market forces us to learn ourselves, to learn what triggers us, what makes us tick, what makes us weak, what makes us greedy. It lets us know what is our biggest source of anxiety. Because when you sit down, as much as you try to ignore life that's going on, it's in the back of your head. You need to realize that that's an issue that you need to fix before you come to the market. But before and above all else, before that and above all else, you need to realize that this is the only path to financial freedom. So you have to. There is nothing that you can tell yourself that will throw you off your game. There is nothing that you can allow yourself to sit there and tell yourself to throw you off your game. This is the only path. This is the only path. I have read a lot of books. I have talked to a lot of people. I've even had the opportunity, the amazing opportunity to talk to a billionaire. This is the only path to financial freedom. You have to hold that mirror up to yourself and say, am I pen networking? Yes, life is lifing. I'm at work right now. I'm stressed out. The kids aren't doing what they're doing. Bills are due. Are you looking at the market? Are you reading the news? Do you know what the economic data is? Are you keeping up, even if you can't afford to invest right now? Are you keeping up with that company so that you're prepared when the money does come in? When you have an extra $20 so that you know immediately where you're going to go invest it at? Are you doing that? Because if not, there's nothing that you need to say to anybody else until you've talked to yourself first. Then you go talk to somebody else. There's no other way. There's nothing else that you can do to get you out of where you are except pray and focus on this. You have to focus on these long-term goals that you have. Like looking, because the market will solve your long-term goals. That job you go to is solving your short-term problems. The market will solve all of your long-term goals. So that is the only focus you can have. That's it. Every move that I make, I'm looking at the phase in front of me. So when I go back to the conversation that I brought down and I talked to all the districts this week about, look at this conversation back June 21st when I told you, look at all of these signs. Everything that we just covered right here was the same conversation in there. Look at the writing on the wall. Look at these signs. Look at history. Look at the buy, or look at the selling. Look at this. Buy these puts now. Because when it drops, what's the emotion that millions of people are waking up and doing? Millions of uneducated and uninformed, which you are not, people are waking up and doing on the market every day. Confused trading. You strategize and you get ready during consolidation because you sitting back looking pretty when it drops or when it goes up. Take breaks when it's needed, and it will be needed. So take a break. My scheduled day from Friday at 4 p.m. until Sunday at 11 a.m., I don't know nothing about the market. Nothing. Nothing. I got other stuff going on. That is the one day I don't look at a chart. I'm not answering any questions. I'm barely in the Discord unless I just got some work to catch up on. I don't want to do nothing about it because I know come Sunday with my job, right? Come Sunday, it's back at it. If we're an average trader, I don't like the word average trader, but you know what I mean, right? The everyday trader, come Sunday night, Sunday afternoon, Monday, whatever it is, you need to take time. You need to take time. And if you look up, because you're keeping your trading journal, you don't know what there's I don't think that there's any job out there that doesn't have a handbook or some kind of course that you got to go through. that you got to read, that you refer back to. A handbook. I know I'm quick to be like, this what your website said, a company. Real quick. That's what your trading journal is. I think one of the easiest non-negotiable, should be non-negotiable ways to become disciplined in the market is by keeping a trading journal. It's the least that you should do. Patience. I'm not a mom. Y'all know I love them kids like they mine though. I couldn't imagine looking at Jada or Javen or Jordan. I couldn't imagine looking at them when they get frustrated with their homework and I'm walking them through it. And when they sit there and be like, man, I'm never going to get this. I couldn't imagine looking at them after hearing them say that and just not say anything. I couldn't imagine not feeding into and pouring into them. Yeah, you can. Yeah, you can. Because you have to. Yes, you can. Because you don't have a choice, black man. Yeah, you can. Because you don't have a choice, little black queen. Plus, you're intelligent, you smart, you got this. I couldn't imagine them saying, I could not imagine them only being in the 5th grade for 1 year. And you learn a new subject every grade. I couldn't imagine them being, or even just one semester. Like what, one semester, the first semester is 4 months. They just now learning how to do division. I don't know what the heck they learning, right? You just now learning that and they're like, I'm never gonna get this. First thing out my mouth is, you just started learning this. What do you mean? Proper preparation leads to something, something, all right? Know your entry, know the full game plan, where you're entering, where you're exiting, all of it, where your stop loss is going to be, where you're like, which is the your contingency plan, the mayday, this is the level where I get up out of this. Set stop loss orders so that you don't have a chance to deviate away from that. Especially if you work in a full-time while you're doing it. And I very much so believe in practicing mindfulness and meditation. I have my own affirmations that I tell myself in the morning for when I'm getting up, just as a human. I got my affirmations as a woman, as a Black woman, as a mentor, as a big sister, right? I feed into myself so that I don't have the time to beat myself up, because I know who I am. And I know that I was made in his image, and his image is nothing but wealth. Never would be here if I wasn't supposed to be here. And I know what it's like in the trenches. I can only speak for myself, right? And I'm going to do anything to stay out of the trenches. And I will do anything to get rid of any distraction that will pull me back into the trenches. And that was what I had for you all today.